The GLD has not had such a great year in 2013, down more than 20%. But here to talk about it a little more for you is Kevin Quigg of State Street. Kevin, great to have you in studio.
Thanks for having me, Joe. I appreciate it.
So Kevin, the first question for maybe people less familiar with the GLD, the ETF, what's the difference between holding the GLD and just going out and buying physical gold?
Sure. Well, there are some primary differences, but really GLD is backed by 100% physically allocated gold at the HSBC vault in London. So it really is securitized gold. And what that means is, unlike the physical market, where obviously it's a market where you need to buy and sell in the marketplace itself, GLD is represented in the secondary market through shares. So it buys and sells and trades just like any other stock.
So why do you want to hold GLD instead of gold?
Well, I think there's a lot of reasons. And again, depending on your situation, physical gold ownership is also a wonderful way to get exposure to gold. Most of the people with whom we speak appreciate the liquidity that the SPDR Gold shares provides. They appreciate the anonymity in some sizes that allows them to buy and sell quickly. Yeah. And also the efficiency. There's a cost savings through the marketplace because of the number of investors that are congregating in GLD.
So people more familiar with the GLD, they keep hearing net outflows of GLD in 2013. What does net outflows mean?
Net outflows means, by its simple perspective, that more people are selling than buying shares of the SPDR Gold shares. Now, if you think about it, SPDR Gold shares has over 1 million shareholders, and there's a million stories behind that of people that are holding the shares for very different reasons.
Yeah.
Now, the one thing that we do caution investors is to not look just at the price of gold, but also the role of gold. What is it doing in your portfolio? And what we've seen recently is people taking money out of the SPDR Gold shares and maybe putting it into other parts of the market, the developed parts of the market that are doing well. And because of gold's price appreciation over the past several years, as well as the price depreciation of some of the other securities markets, some rebalancing is overdue for many investors, and that also can be what we're seeing.
Sure. Now, do you recommend how much of a portfolio people should hold in gold or in the GLD specifically?
Well, we think there's not a target allocation. However, an allocation is appropriate. So regardless of your situation, some investors, depending on obviously what their other assets are going to have unique needs. With that being said, historically, and it's proven itself through the recent credit crisis, but really back through the 1970s and longer still, gold is a resource that within your portfolio really provides stability, diversification, and non-correlated return, and that has value in all markets.
Now, before the GLD, before gold ETFs, people, if they wanted to invest in gold, in equities, they went to the gold miners.
Sure.
What's the difference between the two?
Well, it's really the difference between a gold mining stock is, as the name would imply, you're a beneficiary owner of a single company, and with that comes the company-specific risk. So really the price of a gold mining stock is going to be clearly, on some level dependent on gold. It's also going to be dependent on the relative, poor or strong management of that company, how much or how little gold they're pulling out from their mining operations, and generally speaking, how efficient they are. SPDR Gold shares, again, it is backed by 100% allocated gold at the HSBC vault in London, and because of that, what you're tracking is the spot price of gold as based on the London PM fixing rate.
All right, well, Kevin, thanks so much for that quick primer on GLD.
Thank you, my pleasure, Joe.
For The Street, I'm Joe Deaux.